is on marginal costing principles and absorption, and let's see how best we can know how to apply those principles, and also the aspect of also reconciliation of those profits that come from marginal and absorption. So Ruangwa Limited, based in Lusaka, has been trading for some time making a single product. The company has been using marginal costing principles in preparing its profit statements. A new managing director has been appointed and is considering changing the system used to determine profits to absorption costing. So you have the standard cost sheet, which is as follows there. Then we've given you the monthly production. Fixed overheads are budgeted at 18,000 per month, with a budgeted normal production output of 2,000 units per annum. Fixed sales and administration costs are estimated at 2,500 per annum. The actual number of units produced and sold for the months of April 2020 and May 2020 were as follows. So you have the production units in April and May, so you'd have to prepare for 2 months, and I'm sure that's what they're even going to ask for here. Required: prepare profit statements for months of April and May 2020 using marginal and absorption costing principles. Okay, then finally at the end it's prepare an explanatory statement reconciling the profits under marginal and absorption costing. So reconciliation also has to be known. So we will talk about all this in this video, and let's get started. Back to the standard cost sheet. We want to start the profit statement, and all our profit statements start with sales, as we should know this. We always, as we prepare any income statements, even from your financial accounting knowledge, we always start with sales. So selling price is a 50 kwacha there, but it is at a per unit price. Let's understand that. All these figures you're seeing are at per unit. Okay, so you're going to start multiplying that by the number of units, of course, like those which are below in month of April and May. So that 50 kwacha will be working on only the sales units, because you cannot multiply a sales unit price on production. That doesn't make sense. Huh? So you'd go with sales price, sales units. Huh? That will be the sequence we'll be using. So let's get underway and prepare for the month of April first, then of course May. So when we look at marginal, we're starting with marginal costing, by the way. You would have your sales right there. You'd just, you can just show this in brackets that you're multiplying the 50 kwacha, because you want to know the total sales, 50 kwacha per unit times how many units were sold in this month of, the month of April. Was it about 1.5? Okay, 1.5 units. When you multiply this, it's giving you sales of 75,000 kwacha. That's what you record. Then you would start with other things that make up cost of sale, like opening stock. So the moment they do not talk about opening stock, especially in the question there, then there is nothing. Do not assume. After opening stock, we look at variable, because when you're dealing with marginal costing, you're just focusing on the variable part of production, not the fixed. That's something you should remember. So we're only going to deal with the variable part, and that's it. So you notice that we would have we were told that in April these are the amount of units produced, 1.8. Then we're supposed to multiply them by certain price so that we can know the total variable production cost. Because remember, in these profit statements, you're dealing with kwacha amounts, not just units. No, you want to know the overall kwacha amount. So you have the units times what. So this is variable production. It has to be multiplied by a certain variable production costs. That's the one way it can be changed to that kwacha value we're looking for. So let's get back to the question so that I can show you which variable production cost is there. If we look at our standard cost sheet, variable production cost is made up of what? Direct material, direct labor, variable production overhead. That's it, in fact, those three. So you look out for those three. When they say multiply by variable production cost, they just simply mean what things are variable. Material costs are variable, should know that. Labor costs are variable, and variable production overhead costs are equally variable. So those three, just sum them up. That's what you're going to multiply the 1.8 to. That's what they mean. So that's going to give you 12 plus 9 is 21. Then 21 plus 6, 27. That will be your total variable production costs. Then from there, it will be now easy to just punch there and calculate. So here it's giving us, when you multiply by 27, we're getting a 4. You can just put the figure. Do not take anything yet in this column where there's sales, because we come to push after we have summed up everything that makes up cost of sale. So I'm getting 48,600. Let us move on. Closing stock is equally looked at. Remember, when you're preparing profit statements, closing stock is also part of the calculations. Now, how do we even find closing stock? This is the trick behind closing stock. Usually we do this. We look at the units produced, 1 unit, and the units sold, especially as of the first month, which is April in our case. You can see that they are only selling this, and they are only going to produce, and they're going to produce a total of that. Meaning, when they have some remaining units, yes, they will. Therefore, that remaining difference there becomes your closing stock. So the closing stock will be 300, but we want the cost. What do you multiply closing stock by, especially under marginal costing principle? You have to multiply by the variable costs per unit. Let's understand that. Under marginal, when you're trying to find the cost of closing stock, it's by the variable production cost, which we got as 27. So 27 by 300 gives you what? That should be 81, I believe. Yeah. Then you have your 81, which is closing stock. How do we treat closing stock in our profit statements? It's always subtracted. So remember, this was your variable production. You now have closing stock of 81. You just subtract. Closing stock is a subtraction. You even find your cost of sale. It should be like 40,500, and you have your 75 now waiting for you there. So that was trying to say, this is when you can bring in. This is what they would call your overall cost of sale dealt with. When you subtract these two, in fact here we subtract, you should get 34,500. What do you call this figure? In marginal costing, contribution. So I will show actually a solution of how all this will be put out, how everything should look. But for now, I'm just trying to demonstrate like how you should be recording, calculating, and the necessary calculations, so that at least when the solution is shown, it will make sense. So that's how you reach contribution. What next? The rules now are that I start now listing these fixed costs incurred in the period according to marginal costing principles. Are there any fixed overhead costs in the period? Do we have any fixed administration? All those are subtracted at this point now. So let's look out for them in the question. When you check the question, there is fixed overheads are budgeted at 18,000 per month. So at least we know per month. April there will be 18. May there will be also 18. Take note of that. So they said per month, and they said all these overheads are supposed to be subtracted after you reach contribution. Do we have any admin? We have fixed administration. They are there. Fixed sales and admin. They are there. 2,500 per annum. What does that statement mean? Per annum. It's yearly. Now, as we are in April, why would we put a per annum figure in April? That won't make sense, huh? We also want monthly, just as of April. Therefore, you have to find the monthly fixed admin cost, which will be subtracting each month. So let's do that, and we finish off our profit for April. So these admin expenses, now you just find them monthly. How do you find monthly? You divide by 12 months, because there are 12 months in a year, because that was an annual figure, and then you get this. But I've just rounded off to the nearest whole number. You wouldn't really be marked wrong, because you're just trying to avoid decimals. So this will be what we'll be subtracting under admin. So remember, you had your contribution of 34.5. You now have your fixed overhead 18 per month. You have your admin, which is 208. Then you just subtract and get what they are looking for, the profits as of marginal costing principle in April. Then you just say 34.5, yeah, minus 18 minus 208, 16292. That's the answer. So even May, same approach in May, but I want to just show you one trick before I show you the actual solution, so that at least it makes sense for marginal especially. So this is what happens, especially for months that are following each other. This is something you should remember. The opening stock, let's understand this, the opening stock in the previous, the closing stock in the previous month will open in the next one. That's the sequence you should understand, because this is under realistic circumstances. You're coming from April. April showed that there was closing stock. As you go to May, don't you think there's some stock which will show? Yes. So remember, there was that 300 we found. That 300 has to just be what? Multiplied by the same one, because it was valued at what? At 27. This because we're under marginal costing principle. So remember, our closing stock is valued at the variable cost, which is 81, as the figure that will come and show as opening. So you will start your next period, but remember, opening stock, we will record this 81. Then when you reach, of course, now what's after opening stock? Variable production, the same format. After that variable production, what was the variable production in May? Let's just quickly check the question. So if you check the question in May, variable production is how much? 2,300. Sorry, production is 2,300 in May. So of course I'm going to now have new number of production units, 23, which I'm going to now multiply by the same variable costs, because you're still under marginal costing principle. So what cost do you always multiply on produced units? The variable cost, the variable production cost, which is 27. Then let's see how this is going to change. So you would have this kind of format. Remember, this time around in May, the sales are 2,200 times 50. You have 110 that side. Then I was saying you would have opening here. Opening will be this, because it's coming from the previous period, 81. That was the value. Then now you would have variable overhead, the production overhead, which is 23 as the new produced units in May times what? The variable production cost. Remember, this is marginal. Marginal deals with the variable production cost. Then closing. This is another thing you need to know. How do you find closing? All you know is this. You have opened with 300, and then what is it showing you? For this period, it's like the sales were 2 and you produced 3. Of course, there's some remainder. Realistically, there's some remainder. But how do you actually find closing stock in a scenario when you have opening? You should know this. It's not just looking at the figures and say, no, it's 100. No. What you just do is this, to know what closing stock you're going to record. Say this, produced units in that period, in the next period, 3, add opening, subtract closing. Sorry, add opening, and then subtract sold units, which is how much? 2. So this one you're adding, then this one you're subtracting. You tell me that you land with this is 2 by the way. This is going to give you 400 units for closing. So this is something you should remember. It's like you're starting. This is just, in fact, realistically speaking, you're in a new period. You've come through with the closing from the previous period, which is 300. This period, you go ahead and produce what? 3. Don't you think your stock has now increased? Yes, that's why we're adding. Then now you're looking at what you have actually sold in May, 2. Meaning what is left? That's the reason behind that calculation of 400. Then you just record your 400 at what price? We said if it's at marginal costing principle, always remember you're multiplying by a variable cost, and then you find contribution. Remember, closing stock is always subtracted. You find your contribution, the same procedure. Fixed overheads have to be subtracted. They said that 18 per month. When you look at the other one, admin is 208. We found it 208 for each month. To keep showing, and let me now show you how this month of April and May marginal costing will look. So this is the solution now. Hope it's clear there. While seeing April, May, you just divide your page in 2 so that you can be able to show the 2 months they are being considered. Yeah, so I was saying this is the solution of how it's supposed to be presented. If you saw how we're making those calculations, that's how they are appearing, even there on the screen. I'm sure if you are now able to see. You find contribution, of course, you're listing the same fixed overheads, which they said it's 18 per month. Just make sure you show that, and that's how you get your profits. So this is how a profit statement just looks in general, yeah, just from what you know from your financial accounting. Let's now look at absorption, another costing principle, and see what rules will apply before we reach part B, which is reconciliation of the profits. So you're now under absorption. What things are you looking out for? Well, there will be only one change. Absorption costing principle brings in the fact that you talk about fixed overheads production. Fixed production now is part of the calculations. Remember that time we were just saying only the variable, and then you only come and subtract the fixed overheads in the period. This one is a different approach, and I'll explain as we move. So this is what's going to happen. When you look at your absorption costing principle, we'll start the same. Sales will be the same. If you look at the month of April, the same way we had our sales, it's the same figure because it's still 50 kwacha, of course, per unit. How many units were sold in April? 1,500. You will get your 75 here. Same story. Opening, there's nothing for April. As you said, as long as the question doesn't say anything relating to the first month, there's nothing. Variable, it's actually also shown, but it says that absorption takes into consideration variable and fixed. So variable, the same amount you found, the 48,600, which was just a multiplication of 1/8 times the variable cost per unit, which was the summation of material, labor, and variable overheads themselves in the costs there, and we got 48,600. We look at now fixed, as I said, it's now a new part, fixed production cost as well. We also look at it. How do you get fixed production cost? Of course, there's a word production in that statement, meaning you're also getting the produced units, the 1/8, but multiply them by specifically the fixed cost per unit. How much is it according to the question? When you check the question, fixed production is actually 9 kwacha. So that is the 9 you're going to multiply to the 1/8. That's how you find fixed production costs. So this is the procedure that works through in absorption. So you multiply by 9, what do you get? Because when you get to multiply your 1/8 times 9, this time around you're going to get about a 16,200. So mind you, these costs, first of all, before you take them in the last column, you're just summing them up here first. Closing stock, same figure we found, the 300. These figures actually just the same things. The only thing that has just changed is that we've now included a fixed component, if you have noticed. So closing stock was 300, which was just a difference of the sales and the production, because this is just the first month. They haven't told us about any previous periods, closing stock, nothing. When they haven't said that, usually in the first month, we just subtract the produced units and the sold. That's how we're getting the 300. 300 times what? Because we need to know the kwacha value. So that's going to be what? 300. What cost do you use? In absorption, let's get this part right. It's going to be the total production cost. What is total production cost made up of? Fixed plus variable. I hope we're moving together there. That one was just focusing on, margin was focusing on only the variable cost parts. Now, absorption, total production cost, meaning we also include the fixed costs. Remember what 27 initially at variable, the total variable cost that we found that side. Now what about the overall total production, which even includes fixed? 27 plus 9 giving you 35. Sorry, 36 actually. So 27 plus 9, and you can just go through and punch that, 36. That is your total production cost, which you now multiply on the closing stock. So this is just, these rules just apply on the closing. Closing is the way you would multiply closing under marginal and absorption. These are the rules. In marginal, just use variable costs. In absorption, the total production cost, the way we found it, the 36. Yeah. So you just get to multiply your 36 by 300, giving you 10,800. Done. That's all. What next? Remember, closing stock is always subtracted. That 10,800 we found will be subtracted. But remember, we're adding the variable costs. We're also adding the fixed, the 16,200. Then even if there was opening, we would have added. By the way, said that there was no opening. Then we even find our total this side, which is gonna give you what? Gross profits. Remember, in absorption costing, when you subtract the overall cost of sale and when you subtract your overall cost of sale and your sales, this just gives you what they call gross profit. So I'm sure this time around we should have a gross profit figure of 10,200 after removing everything. So what next? We test for under and over absorption. That's the next rule. Test for under stroke over absorption. What do they mean? Well, you are looking at this. they always give you those fixed overhead costs. They are the ones they state like below the paragraph. They said the fixed overheads are always 18 per month. Like that total that is always calculated. That's like the periodic fixed cost. Like every month you're incurring such. So it's always that your incurred fixed costs, which is the 18,000, being compared to what? Being compared to what is budgeted. Okay, what is budgeted is found by doing this. What is budgeted is that you look at the fixed production cost that you have as a company, which is the 1/8 as of April. That's what we have planned to produce, times what? Since it's fixed you're comparing to, you cannot go and use variable cost to multiply this by. I don't know if you're getting the logic, because these 18, they're from fixed overheads. So even here, we're supposed to find the fixed overhead according to budget. We're also supposed to multiply it by a fixed cost, which is just 9, giving us that 16,200 we had. So now, after you have now found the budgeted one, which is this one, the 16.2, and the one which is incurred in the period, like monthly, they've said it. Sometimes they'll just go direct and say the periodic fixed costs. You get to compare the two and see, have we over or under absorbed? How do you know? When you look at if the one which is periodic is more than what you have planned or budgeted, then what have you done? You have under absorbed. Let's get that logic clear. When what has been incurred in a period, like the 18, which is always incurred, the 18 per month, is more than what you are planning or budgeting, the 16.2, then it shows that you as a company, you have under absorbed, because it looks at you as a company planning. So this 16.2 shows that as we have under absorbed, the actual is more. The incurred is more than what we have done, and you get the difference to know what you've actually under absorbed, which is the difference of 18 minus 16, giving you 1/8. What next? Do you add or subtract an under absorption to your gross profit? This is the next question. When you have under absorbed, this is actually a subtraction. Please, let's get that right. Under absorption, we subtract. Over, we add. These are just the rules behind that. So you add this 1/8 to your gross profits. What next? Remember, in marginal costing, we're like, okay, when you reach that point of contribution, you now start looking at the overheads and the like. Under absorption, the overheads are treated under this particular heading of under stroke over absorption. So once you've dealt with them, the only thing you come and just subtract further will be now admin. That's under absorption. You just look at admin after dealing with the incurred fixed costs in this way. If you notice in marginal, what we had to do was that we just got the entire 18 and subtracted. That's according to marginal principles. In absorption, we get this incurred, test it out in the understroke of absorption, and then we just look out for the difference, and that's all. Once that difference is done, one more thing we just look out for is there any administration, selling administration? What? That's it. And there was only that 208 we found, which is monthly, which are just going to subtract from your gross profit. And I believe you will land finally with your profit figure for this period. Let's just calculate it quickly. Yeah, so I beg your pardon just on the gross profit figure I gave you. It was just a miscalculation somewhere. So remember, we had, these were the variable 46.8. This was our fixed production cost 16.8. Then the closing stock gave us 10.8, which is what subtracting. This should actually be 46.8 plus 16.2 minus the 10.8, which you're now supposed to less from. This is giving me, I think, 52.2, which are subtracting from the 75 sales, which is waiting in this column. Okay. Yeah, so sorry, the variable is actually 48. Sorry for that. It's actually 48.6. Sorry if previously if we wrote it wrongly, just take note. But if you remember, under marginal, I already did it right. It's just that when we started the absorption part, we just misstated the variable production cost, which was just a multiplication of 1/8 by 27. That's according to the month of April. Then of course the rest of the figures should be okay. This should give you this. Yeah, when you get your 54, which is going to be the total cost of sale, when you subtract, it's actually gross profit was supposed to be 21 flat. Then of course, remember the under absorption we found, the 1/8. Remember we always subtract under absorption, and you proceed from there. We just come and list one more thing, which is, as I was saying, admin and what. Same story in May. What was your closing stock? 300, the same thing that we did. 300 was the closing units. In May it will open. But the only thing is that, remember, it was at a certain fixed cost multiplication, total cost multiplication, which is 36. We summed up variable, which was 27, and fixed, which was 9. The two give us 36. So remember, in absorption, when you're multiplying to closing stock or opening, the rules are that it's the total, which is that. Then you still look out for your variable. Remember, there was only one difference. The units changed in May. The units in May were these produced. The units sold in May were 22. But of course, this one by 50. This one, since it's the production, you look at it in two aspects. Just remember that in absorption, the variable part will be times 27. Then the fixed one will be times 9. That's what you will see in the solution I'm about to share. Then same test for overstroke and absorption. In this case, I'm sure there will be a change, because whenever you're comparing on overstroke and absorption, it's still the incurred one. It's still 18 per month. So even in May to be 18, the periodic one. Then which one will be the budgeted as of May? It's the 23 times the 9, because you're looking at the fixed component only when you're treating the understroke over absorption calculation. This one will give you 23 times 9, 27. Here, what has happened? The periodic one is now lesser than what we have planned. What do you call this? Over absorption. How do you treat over absorption? We add it to gross profit. Yeah, so just remember those rules. After you treat that understroke over absorption like this, one more thing you look out for is just admin. Or said in our admin, we know it's 208 per month, the one we calculated. Then you're done. Let me just show you the solution. Absorption costing principle looks just like that. The solution you can see. As I was just saying, remember opening stock is what closed in a period. That's MTN8, it has opened. You've seen, huh? It's the opening stock. Then how do we find closing stock? The same way we found that 400. It's the same way we're also we treated this one. Huh? The same 400 we had found by, you have your opening stock, which is 300 extra. You produced 23. You're now at 26. Less what you sold, 22. You're at 400. And then that 400, since it's absorption, what are you multiplying it with? The total production cost, which is now 36. 36 by that 400 will land you at that 14,400 you're seeing as the closing stock figure in May. So it's just the closing stock calculation that you have to get right. Keep rewinding as much as possible so that you can get that concept. Then everything flows just like this. We can now reconcile. We are now reconciling our profits. How do we do that? How do you reconcile profits? Well, it's about looking at the profit you found in marginal costing and absorption. That's all. Usually that's the gimmick behind that. They just say that if you start with the marginal costing profits, and meaning you're supposed to end, of course, with the absorption. It's like what you're trying to do is that you will look at a change in inventory, which I'm about to explain. And this change in inventory, once you find it, if you started with marginal, you're adding. Please, let's get this part right. If you start with marginal costing, you're adding this change in inventory. Whilst if you are starting with absorption and trying to end with marginal, you're subtracting this change. That's the only trick that's there when you're reconciling. But the whole point is that whatever you start with, it should give you the answer that you found under. If in this case, it should give us the answer that we found in absorption as of April, because here there are 2 months. We'll do for April reconciliation, May reconciliation. So here it's like when we start with the marginal profit in April, we should match the April absorption we found based on this reconciliation technique we're using. So all you just need to know is, how do I find this change in inventory? Because the profits are very easy to pick. It's just about how do you understand the change? Change in inventory is just this. Change in inventory is just the difference between opening and closing. That's all. You look at your closing stock. You're also just subtracting with your opening. That's it. The difference gives you the change in inventory. That's what they're looking for. And once you get your change in inventory, just multiply it by the fixed costs per unit. I hope we are moving together. This is how you just get to calculate the reconciliation part. You have your closing stock, your opening, you get the difference, multiply by the fixed cost per unit, which in our question is 9 kwacha. I hope we're together there. Times whatever difference we're going to get. So in April, did we have opening? It was 0. Closing, we found the 300, if you remember. The difference is what? 300. So it will be now 300 times 9, which will become our change in inventory figure. And since we're starting with absorption, the answer we get this 27. We're just going to add it. If you start with marginal absorption. So usually they just say this, the reason behind this, they say the fact that in absorption you add the fixed element, that's what causes difference in profits. That's the reason behind that. And that's why even when you're reversing this to reconcile, we get to just focus on that same fixed element that was put in there. That's all. So let's do that from our question. So this is what I was trying to explain. Month of April reconciliation. You start with the code, whatever profit you start. Here I start with marginal profits. I start with the marginal profits. The change in inventory should be added. The change in inventory to 7. You add on. It gives you the profit that you found under absorption. You can even confirm this because when you go back to absorption, April, you will find 18,992. Let's just check to confirm this. You can check. This is absorption 18,992. April, you've seen. 18,992. So that's how you would just reconcile the profits. It should match. It's like when you add from the marginal to go to that, it should land on the figure that you found, then you've reconciled. Even May, same story. Would get the marginal profit 32,392. What about this one? What would be the change in inventory? Let's just say we're starting with 32,392. Take note of that figure. And then we should match to this one which closed in absorption in May, 33,292. Okay, let's do that. We look at the change and the like. Take note in May. In May, remember we had some 300 opening because it's coming from the other period. This becomes our opening. And then you want to get the difference between opening and closing stock. Closing stock in May, if you remember from this video, we found 400. When you subtract these two, it's 100 as a change in inventory. How do you get the figure, the cost figure now? Times the fixed cost per unit. Total 900. That's the change in inventory amount. Then you just say, okay, marginal costing profits, the same 30 something, 32,292. You add your 900. I'm sure you would now reach what? 33. Okay. That is it. Yeah, you are adding to your what's this? Your marginal plus the change. What will you land to? You should get the same figure that you got initially. Yeah? So by the way, the marginal costing profit is 32,392. Yeah, just made a mistake there. Then you add on the change, giving you 33,292. That was the profit that was in May absorption. So you will ensure that I've reconciled. So that's how we reconcile. And these are the principles behind marginal and absorption costing principles.